Alright everyone, so let's talk about the world of Forex trading because, honestly, it's one of those things that can either make you a substantial amount of money or, let's be real, it can wipe you out completely if you don't know what you're doing. Picture this. You open up a trading platform for the first time. You see all these charts, numbers flashing, prices for the euro versus the US dollar moving up and down every single second. It's overwhelming, but it's also incredibly exciting because you know that within those movements there are massive opportunities to profit. The problem is most people just jump in head first, clicking buy or sell based on a gut feeling. And that's a recipe for disaster. It's basically gambling, and we're not here to gamble. The reality is that most beginners, and I mean like 90% of them, enter the market without any sort of plan. They see a currency pair going up, so they buy, hoping it keeps going up. Then it immediately reverses, and they panic sell for a loss. They get caught up in the randomness and the sheer speed of it all, and their account balance just slowly, or sometimes very quickly, drains away. This isn't because they're not smart, it's because they're treating it like a casino instead of a calculated business. Success in Forex trading doesn't come from luck, it comes from having a solid, repeatable strategy that you can execute over and over again with discipline. So in this video, we're gonna break it all down. I'm gonna reveal the top 5 Forex trading strategies that are perfect for beginners. We're not just going to skim the surface, we're going to go step by step through each one, explaining exactly how it works, when to buy, when to sell, and how to manage your risk so you don't blow up your account on your first few trades. Whether you've never placed a trade in your life, or you've been dabbling without much success, these strategies will give you the tools you need to trade with more confidence and, hopefully, much better results. So, get ready to take some notes because what you're about to learn could completely change how you approach the Forex market. Alright, so let's get into our very first strategy, and honestly, if you're just starting out, this is probably the most important one you can learn. It's called trend trading. And the entire philosophy behind it is summed up in a classic trading saying, the trend is your friend. It sounds simple, and in concept it is. All we're trying to do here is identify the main direction the market is moving, either up or down, and then just ride that wave for as long as we can. We're not trying to predict the future or catch the exact top or bottom, we're just trying to swim with the current, not against it. So, how do you actually identify a trend? You can't just eyeball it and say, yeah, that looks like it's going up. You need objective tools. One of the most common and effective tools for this is the moving average. You can add this to any chart. A moving average, like the 50-period or 200-period moving average, basically smooths out the price data to show you the underlying trend. If the price is consistently trading above a rising moving average, you're in an uptrend. If the price is consistently trading below a falling moving average, you're in a downtrend. It's that simple. Another classic way to identify a trend is by drawing trend lines. For an uptrend, you look for a series of higher highs and higher lows. You then draw a straight line connecting at least 2 of those major lows. As long as the price stays above that line, the uptrend is considered intact. For a downtrend, you do the opposite. You look for lower lows and lower highs and connect the highs with a trend line. If the price stays below that line, you're in a clear downtrend. This gives you a visual boundary for the trend. Once you've identified the trend, the strategy is straightforward. If you're in a confirmed uptrend, you should only be looking for opportunities to buy. You're looking for a small dip or a moment of consolidation to enter the market, with the expectation that the overall upward momentum will continue. You would never ever try to sell or short the market in a strong uptrend because you'd be fighting against the entire market's momentum. That's like trying to paddle a canoe up a waterfall. It's just not going to end well for you. Conversely, if you're in a confirmed downtrend, your entire focus should be on finding opportunities to sell. You wait for a small rally or a bounce back up towards your trend line or moving average, and that's your signal to enter a sell position. The idea is that these small bounces are temporary, and the dominant downward pressure will soon take over again and push the price lower. Trying to buy in a downtrend is just as risky as selling in an uptrend. You're betting against the path of least resistance. Now, here's the part that separates successful traders from the ones who lose money, even with a good strategy money management. Just because you're trading with the trend doesn't mean every single trade will be a winner. You will have losing trades. That's a guarantee. The key is to make sure your winning trades are bigger than your losing trades. This is where a stop-loss order becomes non-negotiable. A stop-loss is an order you place that will automatically close your trade if the price moves against you by a certain amount. For an uptrend trade, you would place your stop loss just below a recent higher low or below your trend line. This is your exit plan if you're wrong. If the trend suddenly reverses, your stop loss gets you out of the market with a small, manageable loss before it turns into a catastrophic one. Without a stop loss, you're just hoping the market turns back in your favor, and hope is not a trading strategy. It's a recipe for blowing up your entire account on a single bad trade. On the flip side, for a downtrend trade, your stop loss would go just above a recent lower high. Again, this defines your maximum risk on the trade. You know exactly how much you stand to lose before you even enter the position. This is professional trading. You control your risk. You don't let the market dictate how much you can lose. You decide your risk tolerance ahead of time and you stick to it with discipline no matter what. The final piece of the puzzle is your profit target. You need to know when to take your profits off the table. A common approach is to aim for a risk-to-reward ratio of at least 1 to 2. This means that for every $1 you are risking, the distance to your stop loss, you are aiming to make at least $2 in profit. So, if your stop loss is 50 pips away, your profit target should be at least 100 pips away. This way, you only need to be right less than half the time to be profitable. By combining trend identification using tools like moving averages with a disciplined entry plan, only buying in uptrends, only selling in downtrends, and most importantly, with strict risk management using stop losses and profit targets, you create a robust trading system. Trend trading is powerful because it aligns you with the market's dominant force. It's not about being a genius, it's about being disciplined and patient enough to wait for the right setup and then managing your risk like a professional. This is your foundation. Okay, so we've talked about what to do when the market is clearly moving in one direction, but what about when it's not? Markets don't trend all the time. In fact, a lot of the time they just chop back and forth in a sideways pattern like a tennis ball being hit between two players. This is called a ranging market, and trying to use a trend-following strategy here will just get you chopped to pieces. That's where our second strategy, range trading, comes in. It's designed specifically for these sideways markets. The core concept of range trading is to identify a box or a channel that the price is stuck in. This box is defined by a clear level of support on the bottom and a clear level of resistance on the top. The support level is a price area where the market has repeatedly stopped falling and bounced back up. The resistance level is the opposite. It's a price area where the market has repeatedly stopped rising and turned back down. Your job as a range trader is to simply identify these two levels. Once you have your range clearly defined on your chart, the strategy becomes incredibly simple and mechanical. The plan is to buy when the price comes down and tests the support level, and to sell when the price goes up and tests the resistance level. You are essentially betting that the box will hold and that the price will continue to bounce between these two boundaries. You're buying at the bottom of the range and selling at the top of the range over and over again until the range finally breaks. But, and this is a huge but, you can't just blindly place a buy order every time the price touches the support line. Why? Because you have no idea if this is the time it will finally break through. You need some form of confirmation that the level is likely to hold. This is where we bring in technical indicators called oscillators. The two most popular ones for this are the Relative Strength Index, or RSI, and the Stochastic Oscillator. These indicators help you measure the momentum of the price. Let's say the price is approaching your support level. You would then look at your RSI or stochastic indicator. If the indicator is in the oversold territory, typically below 30 on the RSI, it's a sign that the downward momentum is exhausted and a bounce is more likely. This gives you the confirmation you need to enter a buy trade. You're combining the price level, support, with an indicator signal, oversold, to increase the probability of your trade working out. The same logic applies at the top of the range. As the price approaches the resistance level, you look at your oscillator. If it's in the overbought territory, typically above 70 on the RSI, it suggests that the upward momentum is running out of steam and a reversal back down is probable. This is your confirmation to enter a sell trade. You're not just guessing, you're waiting for multiple factors to align in your favor before you risk any of your hard-earned capital. Now, let's talk about the most important part again, risk management. Range trading can feel very safe, but no range lasts forever. Eventually the price will break out of the box, either to the upside or the downside. You absolutely must be prepared for this. This means every single trade you take needs a stop-loss order. If you're buying at support, your stop loss should be placed just below the support level. Not right on it, but a little bit below to give it some breathing room. If the price does break through support and hits your stop loss, you take a small, defined loss and move on. What you don't do is hold on and hope it comes back inside the range. That's how a small loss turns into an account-ending disaster. Similarly, if you're selling at resistance, your stop loss should be placed just above the resistance level. If the price breaks out to the upside, your stop loss protects you from unlimited losses. This discipline is what keeps you in the game long-term. For your profit targets, the strategy is very intuitive. If you buy at the support level, your primary profit target should be the resistance level at the top of the range. And if you sell at the resistance level, your profit target should be the support level at the bottom of the range. You're simply aiming to capture the move from one side of the box to the other. This often gives you a very favorable risk-to-reward ratio. Range trading is a fantastic strategy because it provides very clear entry and exit points. It works best in quieter market conditions when there isn't a strong directional bias. The keys to success are patience, waiting for the price to come to your levels, and confirmation from an oscillator like the RSI. And as always, you must use a stop loss on every single trade to protect yourself from the inevitable breakout. Master this, and you'll have a reliable way to make money even when the market isn't trending. Alright, let's switch gears completely and talk about a strategy that is the polar opposite of patient range trading. This is high-octane, fast-paced, and not for the faint of heart. It's called news trading. The idea here is to capitalize on the massive bursts of volatility that happen immediately following a major economic news release. We're talking about things like interest rate decisions from central banks, non-farm payrolls reports in the US, or GDP announcements. These events can move the market hundreds of pips in a matter of seconds. The reason these news releases cause such huge moves is because they can instantly change the market's perception of a currency's value. For example, if the US Federal Reserve unexpectedly raises interest rates, it makes the US dollar more attractive to hold, and you'll often see a massive, immediate spike in the value of the USD against other currencies. As a news trader, your goal is to be on the right side of that spike. This is a game of speed and anticipation. So how do you actually trade the news? First, you need to know when these events are happening. You have to use an economic calendar. There are plenty of free ones online, like Forex Factory or DailyX. These calendars list all the upcoming news releases, their scheduled time, and their expected impact on the market, usually rated as low, medium, or high. You only want to focus on the high-impact news events, as these are the ones that are going to create the big moves you're looking for. There are a couple of ways to approach this. One method is to trade the initial reaction. This requires lightning-fast execution. Seconds before the news is released, the market usually gets very quiet. Then, the moment the number comes out, boom! The price explodes in one direction. Your job is to identify that direction as quickly as possible and jump on board. This is extremely difficult and requires a very low-latency broker and a lot of practice. Honestly, for beginners, I don't recommend this approach right away. A more manageable approach for beginners is to wait for the dust to settle. Instead of trying to trade the initial chaotic spike, you wait for the first 5 or 15 minutes after the news release. You let the market digest the information and establish a clear short-term direction. Once a clear trend emerges from the news release, you can then apply a simple trend following or pullback strategy to enter the market with a bit more confirmation and a lot less chaos. Regardless of your approach, the absolute most critical thing with news trading is practice, and you do not practice with real money. You need to open a demo account, which is a simulated trading account with fake money, and practice trading these news events over and over again. You need to get a feel for the speed, how different news releases affect different currency pairs, and how to manage your orders in a fast-moving environment. Do not even think about trading a major news event with real money until you've done it successfully on a demo account at least 10 or 20 times. Now, a massive word of warning: leverage. Leverage is what allows you to control a large position with a small amount of capital. During news events, brokers often offer very high leverage. This is a double-edged sword. Yes, it can magnify your profits, but it can also magnify your losses at an incredible speed. A move that would normally be a small loss can wipe out your entire account in seconds if you're using excessive leverage. When trading the news, you must use very low leverage, or none at all, and your position size should be much smaller than usual. Another huge risk during news events is something called slippage. This is when you try to enter a trade at a certain price, but due to the extreme volatility, your order gets filled at a much worse price. The same can happen with your stop loss. You might have a stop loss set at a specific level, but the market moves so fast that it gaps right past your stop, and you get closed out at a far bigger loss than you intended. This is a real risk you have to accept if you're going to be a news trader. So, to recap news trading, you use an economic calendar to identify high-impact events. You decide whether you're going to try and trade the initial spike or wait for the initial volatility to die down. You practice extensively on a demo account to get a feel for the speed and execution. And you are extremely cautious with your leverage and position sizing, fully aware of the risks of slippage. News trading can be incredibly profitable if you get it right. You can literally make a week's worth of profit in a few minutes. But it's also the fastest way to blow up your account if you are unprepared or undisciplined. It's the sprint of the trading world, whereas trend and range trading are more like marathons. It's an exciting strategy, but you have to approach it with an immense amount of respect and caution. Okay, let's move on to our fourth strategy, which is a personal favorite of mine because it often signals the start of a big new trend. This is called breakout trading. Remember how in range trading we were betting on support and resistance levels holding? Well, breakout trading is the exact opposite. We are now betting that these levels will break, and when they do, we want to jump on board for the ride. A breakout is essentially the market breaking out of its cage, and it's often followed by a strong, sustained move in the direction of the break. The first step, just like in range trading, is to identify key levels of support and resistance. These can be the highs and lows of a sideways range, or they could be major swing highs or lows from a previous trend. You can also use chart patterns like triangles, flags, or pennants, which are all consolidation patterns that signal a big move is coming. You draw these levels on your chart, and then you simply wait. Your job is to be a patient hunter waiting for the price to make its move. A breakout occurs when the price decisively closes above a resistance level or below a support level. I want to emphasize the word decisively. A common beginner mistake is to jump in the second the price pokes its head above resistance. This is often a fake-out, where the price quickly reverses back into the range, trapping all the eager breakout traders. You need to wait for a candle to actually close beyond the level on your chosen time frame, like a 1 hour or 4 hour chart. This shows stronger conviction from the market. Once you have a confirmed breakout, how do you know if it's the real deal? One of the best confirmation tools you can use is volume. While true volume isn't readily available in spot Forex, many brokers provide a volume indicator that shows the amount of trading activity. A genuine breakout should be accompanied by a significant increase in volume. A spike in volume tells you that there's a lot of power and conviction behind the move, making it much more likely to continue. A breakout on low volume is suspicious and has a higher chance of failing. So, the entry signal is a candle closing beyond a key level, preferably on high volume. If the price breaks out above resistance, you'd place a buy order. If it breaks down below support, you'd place a sell order. But where do you put your stop loss? This is crucial for managing the risk of a failed breakout. For a bullish breakout, above resistance, the logical place for your stop loss is just below the resistance level that was just broken. That old resistance should now act as new support. If the price breaks out and then falls back below that level, it's a sign that the breakout has failed, and your stop loss will get you out with a small loss. For a bearish breakout, below support, you'd place your stop loss just above the support level that was broken. That old support should now act as new resistance. If the price rallies back above it, the breakout is likely false, and you want to be out of the trade. This gives you a very clear and logical exit plan if you're wrong. What about taking profits? Breakouts can lead to very long and powerful moves, so you want to give the trade room to run. One common technique is to use a trailing stop. A trailing stop is a stop-loss order that automatically moves up as the price moves in your favor. For example, you could set it to always stay 50 pips below the highest point the trade has reached. This allows you to lock in profits as the trade progresses while still keeping you in the trade to capture a much larger move if it happens. Another method for taking profit is to measure the height of the previous range or consolidation pattern and project that distance from the breakout point. For example, if the range was 100 pips high, your initial profit target after a breakout would be 100 pips above the resistance level. This gives you a concrete target to aim for, based on the market's previous volatility. It's a simple but effective way to set a logical profit objective. Breakout trading is exciting because it gets you in at the very beginning of a potential new trend. The key is patience to wait for the setup, discipline to wait for confirmation like a candle close and a volume spike, and a strict risk management plan to protect you from the inevitable fake-outs. Many of the biggest and most profitable trends in history started with a simple breakout from a consolidation pattern. So you identify your key level, you wait for the price to break and close beyond it, you look for a surge in volume to confirm the move, you place your stop loss on the other side of the broken level, and you set a logical profit target or use a trailing stop to ride the momentum. This is a proactive strategy that puts you in the driver's seat, ready to capitalize on shifts in market sentiment. It's a powerful tool to have in your trading arsenal. Alright, for our fifth and final strategy, we're going to combine some of the elements we've already learned. This one is called pullback trading, and it's a favorite among professional traders. The idea is simple. We know that markets don't move in straight lines. Even in a strong uptrend, the price will have periods where it temporarily moves down or pulls back before continuing its upward journey. As a pullback trader, your goal is to buy during these temporary dips. It's the classic advice of buy low, sell high, but applied within the context of an existing trend. First and foremost, this is a trend-following strategy. So, your first step is exactly the same as in our first strategy. You must identify a strong, established trend. You can use moving averages or trend lines to confirm that the market is in a clear uptrend for buying pullbacks or a clear downtrend for selling rallies. You are never, ever trying to trade a pullback against the primary trend. You're only looking to rejoin the trend at a better, discounted price. So, let's say you've identified a strong uptrend. The price is making higher highs and higher lows. Instead of chasing the price and buying at the top of a move, which is a common and costly mistake, you patiently wait for the price to pull back. But how do you know where the pullback is likely to end? You need to find a potential area of support where the dip might stop and the trend might resume. This could be a previous resistance level that should now act as support, a rising trend line, or a key moving average like the 50-period EMA. This is where you combine technical levels with indicators. As the price is pulling back towards your identified support area, you want to see signs that the selling pressure is fading and the buyers are about to step back in. This is a perfect time to use an oscillator like the RSI. In an uptrend, as the price pulls back, you would watch the RSI. If the RSI dips into or near the oversold territory, say around 30 to 40, as the price hits your support level, that's a powerful signal. It tells you the pullback is likely overextended and the trend is ready to resume. So your entry trigger is a combination of things. First, price is in a clear uptrend. Second, price has pulled back to a logical support area like a trend line or moving average. Third, an oscillator like the RSI is showing that the pullback is losing momentum. When all three of these conditions are met, you have a high probability entry signal to place a buy order. You're not just buying a random dip, you're buying a calculated dip at a specific area of value. The same logic applies in reverse for a downtrend. You identify a strong downtrend. You wait for the price to have a temporary rally or a pullback upwards. You look for this rally to stall at a key resistance area, like a broken support level or a falling moving average. As it approaches that resistance, you look for your RSI to enter the overbought territory, signaling that the rally is running out of steam. This is your cue to enter a sell trade, rejoining the dominant downtrend. And, you guessed it, we have to talk about the stop loss. This is what makes the strategy so effective from a risk management perspective. When you buy a pullback in an uptrend, your stop loss can be placed very tightly, just below the support level you bought at. If that support level breaks, it's a sign that this wasn't just a pullback. It might be a full-blown trend reversal. Your stop loss gets you out quickly with a very small loss. Because your entry point is at a discount and your stop loss is tight, this strategy offers an excellent risk-to-reward potential. For your profit target, a logical first target would be the previous high in the uptrend. If the trend is strong, you can expect the price to at least retest that high and likely make a new, higher high. This often gives you a risk-to-reward ratio of 1 to 2, 1 to 3, or even better, which is exactly what you want. Pullback trading requires a lot of patience. You might see a trend taking off and feel the urge to jump in, the classic fear of missing out or FOMO. You have to resist that urge and have the discipline to wait for the price to come back to you. Let the market present you with a low-risk, high-reward entry point. Chasing the market is a losing game. Letting the market come to your level is a professional approach. This strategy is powerful because it gets you into a strong trend at a much better price, which both increases your potential profit and decreases your potential risk. It's a refined way of trend trading. You identify the trend, you wait for the discount, the pullback, you look for confirmation at a key support or resistance level, you enter with a tight stop loss, and you aim for the trend to continue. Master this, and you'll be trading like a seasoned pro. So there you have it, a complete, step-by-step guide to the top 5 Forex trading strategies for beginners. We've covered everything from riding long-term trends and trading inside a range, to capitalizing on explosive news events, jumping on breakouts, and buying the dip with pullback trading. Each of these strategies is a powerful tool on its own, but together, they give you a versatile playbook to tackle almost any market condition. The key takeaway is that you should never, ever enter a trade without a clear plan. You need to know your entry reason, your exit plan if you're wrong, and your profit target if you're right, before you even think about clicking that buy or sell button. But please, don't just watch this video and immediately jump into a live account with your life savings. That's not the path to success. The next step is to open a demo account, it's free, and start practicing. Apply these strategies. Test them on different currency pairs and different time frames. See which ones fit your personality. Make mistakes, learn from them, and figure out what works for you without risking a single dollar. Your demo account is your training ground. It's where you build the confidence and the discipline that you will absolutely need to succeed with real money. Remember, successful Forex trading is not about getting lucky on one big trade. It's not gambling, and it's not a get-rich-quick scheme. It is a business that requires skill, patience, and discipline. It's part science, analyzing charts and probabilities, and part art, getting a feel for the market flow and managing your own emotions. The journey is a marathon, not a sprint. So take these strategies, practice them diligently, manage your risk obsessively, and over time, you can build the skills to become a consistently confident and profitable trader. Thanks so much for watching. Smash the like button for the YouTube algorithm, and I'll see you in the next video.